Hi, everyone. Yeah, I already have a first question. We will share a video of this afterwards. I think so. We've tested it. It seemed to be working, so we plan to share the video with attendees. Welcome, everyone. Okay, awesome thanks so much for joining. I know we have actually loads of people here. I know for a lot of people, it's actually pretty late. We have people even from Japan. I don't know how you stay alive, but thanks for joining today. I hope you're going to find it super useful. And honestly, we have actually loads of ground to cover. So let's get started. I'm going to kick off the presentation. And while I'm doing that, I do want to give you a warning that I'm not going to be seeing the chat. So I'm basically just going to roll and present and occasionally switch it off, check for any questions. So if you have any questions, please send them here. I'll try to get through all the content and leave some time for questions as well, and maybe take some of them on the way. Awesome. Okay, let's get this party started. Okay, I believe you should be able to see my screen now. I'm just gonna go into the present mode. So today we're going to talk about the survival guide around fundraising and how founders can raise in 2025, particularly from VCs. I call it the rule of dating because I think it's super similar. It's similarly confusing for a lot of people. It requires a lot of effort. It's very difficult to understand who to raise from, how to do it, what are the rules, and that's something we're going to try to dive into today. So quickly on who I am, I've spent 11 years in VC space, finance background over my career, so over 700 rounds, helped companies raise over 3 billion overall. I'm also a ex-CEO of Clevo, which is an AI e-com company where I've helped to scale to 8-figure ARR, and then we've just exited to a private equity company last month. So essentially been on three sides of the table. I've been on the side of the founder, helping them to build the story to fundraise. I've been on the investor side as well, helping a lot of VC funds do due diligence of different opportunities, so I know what they're looking for, and also being on the operator side, going through all of the pains of reaching product market fit, scaling, selling. So hopefully this provides a bit of a, well, maybe not unique, but interesting and useful perspective. Okay, what are we going to try to cover today in a very limited time we have? Overall VC fundraising landscape in 2025. Asked over 100 different founders, over 100 different investors who raised last year, who are raising right now, what are they looking for, and try to pack all of those insights into this webinar. This also includes where funds are investing and a little bit of a guidance around round sizes and valuations you might be expecting. We'll try to cover the core fundraising tactics and then some of the largest mistakes that might kill your fundraising chances. And then the number one most common question I typically get is how to secure meetings without network. So we're going to try to cover that too, and then loads of more. So VC fundraising landscape in 2025. Let's start with a history lesson. I don't think people like histories that much, but I think it's going to be useful. And the reason it's going to be useful is because I speak with a lot of founders that I think are still stuck in this 2021 beautiful time where essentially it was a golden VC time, crazy valuations, best time to raise money. Back in 2021, we've actually worked with a company in the SaaS space that raised a 20 million Series A round, having only 50K of annual recurring revenue. That's impossible to imagine now. They had like a very rough MVP product. They practically didn't have revenue, and they raised the 20 million round on zero revenue in a span of 3 weeks. That's how great the times were. Well, from there, somewhere in 2022, the market has dropped and we went into what was called a massacre. So that was accompanied with a VC market crash. Very few companies being actually able to raise. Some still managed, but a lot of attention was on profitability, on how to survive, and so on and so forth. And then somewhere with the Gen AI era, the market started being recharged, mostly for AI companies, but for some of the others as well. Valuation stabilized, but overall fundraising remained challenging. So we're kind of in that limbo space where things are getting better. They're nowhere at the level of 2021. The big paradigm shift that happened was it used to be that you needed to get fat and then you could get fit. So essentially you would raise money to get to product market fit, which was easy, very comfortable. Today, you need to get fit first and then get fat. So you need to reach product market fit, you need to get customer validation, and then raise money. And I think it's very difficult to swallow for a lot of people who are still used or think it's kind of like the old times. And unfortunately, it's not. So what does it mean for founders? Up until 2021, growth was a king. Top line was everything that mattered. So as long as you had money, you could pour all of that money into acquiring new customers, grab market share, and you would be fine. You would continue to getting checks. 2022, everything massively changed. Efficiency became a king. It was a quest for profitability. Everyone was looking at rule of 40. Everyone was looking at how long you're going to survive. And now, dare I say, we're probably in the most challenging era where it's about growth and efficiency. How lucky we are. So AI becomes table stakes for a lot of products. Fast growth is a must. Honestly, you practically can't get financing, especially in US, unless you're growing fast. And in this respect, I think AI companies have kind of ruined it for everyone, because if you have a company like Cursor reaching 100 million in revenue in 1 year with like 20 employees, then investors look at whatever startup you're bringing them and they're like, well, it's no Cursor, so do I want to invest? It becomes very, very challenging. Traction rules, metrics, NRR very often, which is the net revenue retention. Efficiency is important. It can be overlooked in earlier stages, but no one wants to invest in bloated companies. So essentially you have to be lean, you have to have automated operations. The most recent craze is that no one wants to invest in large teams, because large teams are equivalent to inefficient teams, especially because so many AI-first companies are tiny when they reach all of those massive unicorn statuses. So Ariel, partner at Scale Venture Partner, he said, great. He said, the sweet spot for all is essentially high growth companies that can become profitable in a realistic time frame. It's a flight to quality. So high growth plus strong efficiency. Obviously, no easy feat. What does it mean if we dive a little bit deeper at expectations at different rounds? And I usually get a lot of pushback at this table. So I want to say this is median. It excludes a lot of outliers. Obviously, things are very different in deep tech, in biotech. Very often in hardware, you would see larger rounds. In deep tech, you wouldn't see validation in the beginning whatsoever. But for majority of the market, so if you take median for 90% of the market, at pre-seed, you already expect customer validation and early users. You might even expect revenue. You need to have at least few people team. So a one-person team, unfortunately, is very unlikely to raise money from investors. And the reason is people believe that if you haven't persuaded anyone else to join you on this journey as an employee or as a co-founder, then why are you looking for an investor? You would have the same challenges with investment, with early customers, etc. On the product side, even at pre-seed level, MVP is now kind of a norm. A round size would normally be less than 2 million, and a very common mechanism would be safe. So it's going to determine, or convertible note, how much equity you're going to raise. If you're doing a price round, it would be around 10 to 15% equity. Is it always true? No. I work with companies that have raised 4 and 5 million pre-seed round, having only Figma wireframes. But usually those are companies that have exceptionally strong teams. And I'm going to get to that a little bit later in terms of what do investors mean and understand by exceptionally strong teams. At a seed level, you're expected to have some level of product market fit, often 15 to 30% month-on-month growth, can be even $1 million in revenue. a very robust product at that stage, and you probably would be raising from 2 to 5 million. Again, there are mega rounds, there are much larger seed rounds, but typically that's probably what you would be looking at, and then giving away around 15 to 25% in equity, with 20% being median and average. And at Series A, your revenue is expected to be well over $1 million. You would normally be raising 6 million to, I think, 30 million plus. Average is around 10. What it means is that, and a lot of people don't like it, but round expectations did change. So pre-seed rounds now require some level of validation and often even first revenue. So we work with someone in Europe working on a AI first solution that looked really interesting. They had great technology. They actually had validation that that technology worked even better than potentially competitors, and VCs would still not invest until they had that kind of initial growth. They had, I think, 100 test customers actually who used the product and liked it, but the growth, the revenue growth and the splendid levels of retention were not really there. So for investors, it was a no, even though it was still a pre-seed round, even though it was very small, it was less than 1 million. So to be able to raise this, unfortunately, validation is going to be key. Seed rounds are now companies that are often doing serious revenue. So Creandum, which is a European fund, great guys, they're investing in the likes of Spotify. They're now seeing companies with at least $500,000 to 1 million ARR. And this used to be a benchmark for Series A that's now essentially moved to seed. Series A is now rare for companies doing under 1 million, and usually it's 2 million, can be up to 6. Series B are more companies approaching 10 million ARR rather than 4 to 5. So something to keep in mind. What is a key success at each stage? In pre-seed round, your key success factor would be team, ideally someone who scaled, exited a company, but also that early traction. So product MVP, customer validation, waitlist, early revenue, you name it. In seed round, your key success factor will be early indication of product market fit. That would be growth plus stickiness. So how fast are you growing and are you retaining customers? Plus team, customer love, and customer references. At Series A, things become a little bit more difficult because you need product market fit. So you need the growth and the stickiness, but you also need go-to-market fit, which essentially is success with at least one marketing channel, indicators of scalability. Basically, the fact that you can scale the channel at a very good CAC payback, at a very good LTV CAC, proof of a repeatable sales model versus founder-led sales, and really good net dollar retention, which used to be at 100%, but I think now investors are actually looking at 110% and more. When we say what's good on the team, product, traction, and GTM, I think we always understand, different things. So just to set the vocabulary, the team and founders that have a personal track record of success is great, but it's kind of meh. The good bit is founders that build successful companies in the past or have very deep domain expertise. But the really great one is founders that have a very successful startup in the past, that can rally people around them, have access to very influential network, and probably exited another business. On the product side, stuff like wireframes or not ready product would normally be a meh. MVP and early signs of differentiated product is generally good. The great bit is if your product is ready and it's already 10x better than market alternatives. And I'm actually hearing investors now using terminology 100x better because now you have AI to make it significantly better. So you choose, but it needs to be significantly better. On the traction, I think anything around like waitlist, PR, customer quotes is good, but kind of a bit meh. The good, if you have months and months growth, early contracts, growing pipeline. Great is when you have undeniable early adopter traction. So that's organic word of mouth. It's a lot of engagement, a lot of users that comes from people who are using it and loving it. That's something investors are going to value. And then most importantly, I think a very ignored area of go-to-market. I see loads of people basically just saying, we're going to do paid and social, and we're going to do also a bit of SEO, this and that. That's generic marketing, and that's not very welcome by investors. So a good bit if you have early validation velocity from at least one channel, and The great would be if you have a really interesting, unique go-to-market playbook that somehow is driven by word of mouth, community-led growth, whatever that is. I'll come back to that a little bit later as well. I'm almost done on the math, I promise, but because I get these questions a lot, what kind of average numbers we're looking at. So at pre-seed in US, you're normally looking at $500,000 to $1 million median to average round size. All of the data is as per 2024. 70% of all rounds were under 1 million. Average valuations were at 5 to 6 million. In Europe, you would always see 2x smaller round sizes in pre-seed, sometimes less, so like, let's say, 50% smaller round sizes, and then smaller valuations, although they have been growing quite a lot over the past year. And then rest of the world, if you look at Latin, Middle East, etc., can be even smaller. In seed, you would be looking at around 3.3, 3.8 average round size in US, and again, 12 to 15 million average valuation. And then again, I think this is more of a typo on my end. I wouldn't say it's 2x smaller, but 50%, 20 to 50% smaller rounds and valuations in Europe, and then 20 to like 30% even more in the rest of the world. Series A becomes somewhat universal. So between US and states, the average round size at around 10 to 12 million, and then valuations at around 40 million. Again, rest of the world would be looking at least 50% smaller Series A usually. And finally, if we cover the math of which sectors are hot versus not, as we go into 2025, we've tried to ask as many investors as we can. And I think obviously it depends because each fund has its own specialization. Like there are funds that exclusively want to invest in IoT or Web3. But generally, the hot sectors, of course, AI. I think this year's craze is all about AI agents. So last year it used to be AI co-pilots. This year it's AI agents, and essentially AI software that has a very specific use case, has proprietary data or some level of IP, because the big argument in the VC community is what's going to differentiate one AI startup from another, especially because in every sector that AI has entered, now there is an absolutely red-blooded ocean of competition. So the idea is it's probably going to be data or maybe something unique around the distribution. So those AI companies that have the data or distribution advantage, have a clear use case, they are in very high favor. And again, probably the most common thing that gets a lot of investor attention is AI agents for a very specific case, where you're able to automate the very big part of the process, remove user pain, and essentially leave human just because of the for the oversight. Then we have a couple of sectors that are kind of increasing in terms of their attractiveness. So we have the ESG, climate tech, everything related to renewables, EV tech, etc. 50% of VCs plan to allocate more funds to these sectors in 2025. Interestingly, it even covers hardware in a way, if it's climate tech related. I'm yet to see evidence that this is going to happen, but at least that's what people are talking about. And then we have defense, miltech, and govtech. That was a record deal volume in 2024 and is on trend to continue. Deep tech, everything from semiconductors, robotics, quantum, space, etc. And traditional, I think, sectors that are still investor darlings in a stable way, healthcare and biotech, as long as those companies are able to present solid science and commercial savvy strategy. Fintech, and of course, B2B enterprise software, cybersecurity just continues to collect loads and loads of money. So sectors that are not so hot. Web3 and blockchain. It's still on the agenda for a lot of specialized crypto investors, but much less so for general VCs. Exception is when there is a differentiated play or blockchain tech as a backend for example, fintech, supply chain, etc. Any overcrowded niches, things like delivery, NFTs, quick commerce, considered play out themes right now. Consumer retail and direct to consumer, that's my personal pain. I love a lot of those companies. We've worked with a lot of those companies, but many public direct to consumer companies essentially floundered in terms of their valuations due to unsustainable unit economics, very high CAC, low margins. And obviously, if you compare that traditional physical business to the likes of AI, it's very difficult to understand why you would invest there. Luckily, there are a lot of specialized funds that still continue to look in this space. But in order to raise right now, you need breakout traction and amazing unit economics. And it's very difficult otherwise. EdTech and MarTech, unfortunately, kind of like at the bottom of the pile as well. They're just not perceived mission critical and are also very crowded. Non-essential consumer apps are in the same space. So things like social networks, media apps, content platforms. It's just a much higher bar. So you have to show the massive consumer adoption in order to be able to raise. Things like fitness and restaurants or technology aimed at fitness clubs, restaurants are not in favor because the underlying customer base is struggling. So the thesis is if your consumer are struggling, are going to be churning in high quantities because they don't have a lot of money. If you're targeting your business at very small, for example, you have a subscription model aimed at very small startups, aimed at gyms, aimed at small restaurants, QSR, etc. Those are the type of users that exhibit high churn behavior because a lot of them are struggling. And any solutions aimed at that, especially if they're in the subscription or SaaS space, currently are deprioritized by a lot of VCs. Okay, so new 2025 trends. I'm actually going to start with negative first and then go to positive. So fundraising can be brutal. I think you need to expect rejection and inefficiencies and plan accordingly. There is increased competition for deals. I've seen in the past months, probably 5 different companies raising in AR, SDR space. And already there are probably another 30 companies that raised in this space. So when there are so many similar solutions in a similar space, what ends up happening is investors have already seen this pitch. You come to them, you've prepped, you've developed your MVP, and they say, well, you know what? We've already heard this. We've invested in something similar. We think it's too crowded. Speed becomes essential. Literally, sometimes it's a scope of 2 months when you would go from something that's super interesting to something that actually has been implemented by others. So remember that, and speed of execution, speed of communication with investors is super essential. Investor behavior remains inconsistent, unpredictable. You also need to expect longer fundraising cycles. Often now raising for 2024 to 36 months is a norm. I think 24 months is probably your golden middle, and down rounds are coming too. On the positive side, investors do have more dry powder than ever, so they sit on a lot of money. There are more investments going in Middle East, Africa, LATAM, which is great. The big funds have slowed down, but there's a lot of small new funds and angel syndicates. So in 2024, actually, a record number of sub 50 million VC funds was formed, and a lot of nano funds that are sub 10 million that are often led by operators or angels. And those are the people who can write you the first check to get you to the first traction point on when you're going to be ready to raise from a big VC fund. And then more and more non-traditional options around venture debt, revenue-based financing providers, et cetera, appear. So even if you're unable to raise from VCs, you definitely need to look into all of the other possible ways to finance your venture because they're becoming more and more every day. So before I go into where do we go from here, I'm just going to quickly check the questions section and see if there are any questions that I need to talk about. I see that Saad said there was no sound. Guys, do we have sound? Okay, Saad, you got me really worried. So good that sound is okay. Okay, let's continue. Okay, so where do we go from here? The tips and tricks, mistakes, and actionable strategies forget about the numbers. We can dive in on how you can actually conquer this landscape in 2025. So let's go. The number one biggest secret of, and actually my team is letting me know that I didn't see the question section, which was different from a comment section. So let me address the questions first. I think we have a few quick ones. Yes, Andrew, now I see that there is a questions tab, so I'll check there. So we have first question, would ed tech fall under government tech into what's hot and what's not slide? I don't think that ed tech itself would fall under gov tech, unfortunately. There are, again, in every sector, there are startups that raise, and in every sector, there are going to be darlings and investor darlings that raise and that are super successful. But ed tech is not one of those. I think ed tech is still popular with with investors that understand it really well and are looking to invest there, but it's definitely not one of the hottest sector. We also have a question around what happens in domains like gaming, where you don't have revenue until and unless the game is made. I think things are really tough. Like, we've just looked into a gaming deal last week where the same question appeared, and they have already invested over 1 million in the development of the game. They just needed a bit of an extra million to get them to the point when they can publish, and no one wants to give them this money because people want to have validation. I think in the gaming space, generally, it's a difficult market. What I can say, we work with some startups, with some funds that are specifically targeted at gaming. So people understand games. I think they're willing to finance some of those. Gaming infrastructure and gaming tech is on the rise, so that's okay. But specifically games, I think, is challenging. You need to find someone who believes in this. You need to find someone who is going to finance this. Very often, it can be angels. But also you need to understand that the way you do a game needs to be non-traditional in a way. So right now, there's loads of developers that use AI to very quickly produce assets, produce an MVP, test it with customers, and see if the concept is actually going to work. So you need some level of validation, ideally. Okay, we have a question from Ahmed. How do you manage expectations of different VCs and how much do you charge? I need clarification on that. How much do we charge? How do VCs charge? But on the question around how you manage expectation of different VCs, I think you just start speaking to them. It's the same as, again, dating. You would go on a date and you would meet someone and you would need to manage their expectations in a way and find a way to converse, and all people are different. So it's just about getting in the process. Okay, do we see pre-seed investors going in the MVP development phase of a SaaS B2B product with strong indicators or written commitments from customers? It's an interesting one. Sometimes, yes, if the team is really strong, but overall, unless the team has made a super strong impression, investors want to see those commitments becoming actual money. So we've seen something like this before, and that was the case. Okay, I'm going to take one more, and then we need to move because I'm afraid we're not going to finish the presentation. So how do we see construction tech for 2025? Commercial, residential, real estate, actually really strong. I think for construction tech and everything related to real estate tech, the benefit is that you always have the traditional VC market. You have a very large addressable TAM. The market is still super fragmented. A lot of solutions are very, very outdated. And also, if you can't raise from VCs, you can actually raise from real estate investors. You can raise from big developer companies. Like, the market is so big that there's a lot of financing options. So I think when it comes to construction tech, the market is actually pretty good. Or at least, like right now, we're working on one construction tech deal, and the investor interest has been really strong. So I think, again, given a few more before, it's probably going to be pretty good next year. I know we've got loads of more questions. I'm going to come back to the presentation, and then I'm going to try to cover them once we finish, I promise. Otherwise, I'm afraid we're not going to get through the entire thing. Okay. This is going to be anticlimactic now because I've shared this slide and then went to answer a question. But the number one biggest secret of fundraising in 2025 is don't wait till you fundraise to engage with investors. Statistically, or what we hear from the funds, is that 90% of all VC investments last year were outbound. And what it means when I say outbound means investors are actually looking for investments, finding them, and then they're fast tracking and they're investing. That means only 10% were inbound. And that means that in order to raise money, you need to put yourself on a VC map way, way before you're actually going to need money. So how to do it? Quick cheat sheet. One, make a list of IAP, what I called VCs, and that's similar to ICP, so your ideal customer profile, but it's your ideal investor profile. So who invest in similar stage, similar region, similar checks, who would be your ideal investor. Start engaging as soon as you either raised your pre-seed, seed, etc., or if you haven't raised yet, start engaging way before you need money. Build relationships, understand the milestones they're looking for in the next round. So essentially the way it would go, you'd connect with them and you'd ask them, what are you looking for to get the company funded at this stage? And normally they would tell you very specific things like, we want the company to be at X revenue. We want the company to be at this level of retention. We also would like to see a team that has experience in XYZ. So essentially you have your blueprint. You don't have to guess. You don't have to think around what the next round is going to be like. The fund itself already gave you a blueprint of what they're looking for. And what you do then is you keep in touch with its investors over email, maybe over coffee. You update them on your progress, ideally quarterly, can be once every few months. You have to crush the milestones with a few months of runway left, or you crush milestones until you've built what you plan to build. And you tell the investors that you have built a relationship with, that you're about to run a process, but you wanted to give them the first look, and then you swim in term sheets. So that's your best strategy. It's not always feasible, but if you are still very early on, if you're just thinking about fundraising, if you just raise your first family and friends round, then this is the best thing you can spend your time on to maximize your chances of fundraising later in the year. I think Sarah Chen Spelling, she said it great. Build investor relationships early. Networking is crucial, and you need to build genuine relationship before you need the money. Why? Because investors back founders they know and trust. A lot of investors we speak with say they invest in lines versus dots. So that early connection lets you update them on your progress over time. And by the way you officially pitch, they've already seen you execute, they've connected the dots, and they're happy to give you money. An extra tip is, even in rejection, ask the VC to stay in touch. Send monthly and quarterly updates. So let's say investor come back and they say, sorry, that's not a fit. Tell them thank you, but do you mind if we stay in touch and I keep you updated around how we move? I like the conversation. I like you guys. We've actually had a few clients where VCs invested after 5 or 8 progress updates. So they've said no, and then they've seen the company executing and building, and then they came back and they gave a term sheet. So you need that grit, polish, and strategy to make the venture world take notice of you. But essentially the question is, if 90% of all VC investments are outbound, are you doomed? And will you never raise money? The answer is no, but you will need to adjust a little bit. So there's 3 super signals that VCs use for investments. One is the team. Second one is traction. And third one is other investors investing. And that's because there's a lot of herd mentality in the VC world. So how do you take that on board? With team, obviously you need to find an A-class team. You need to position or present yourself in a really right way. And you need to network and network and network. I'm the one who hates to network. So, I feel your guys' pain if you don't like to network, but there is no way around it. The second one is traction. You need to focus on building and securing customers, working on validation daily, right? That amazing kind of chart on each and every metric, improving it daily is going to be critical. And then other investors, again, it's about building relationship to secure a lead or secure early investors that then spread the word. let's dive into it a little bit deeper. So when we say position team for success, what kind of a team signals to investors that they want to invest? So obviously what VCs love most is previous exits. Why do VCs love most previous exits or previous experience of scaling VC-backed businesses? Is because 60% of unicorn founders statistically are repeat founders. 42% of unicorn founders had a previous 10 million plus exit. So the picture on the right is supposed to portray in a very easy to understand way that, whenever a VC hears exited founder, that's something that attracts their attention quite a lot. Obviously, not a lot of, especially first-time founders can bolster, an exit or scaling a large business. So what can we do instead? Other things that work. Anything related to entrepreneurial experience, scale up serial founders is pretty good. Work experience in very high selective environments in your domain, if you have very deep knowledge of your domain and can demonstrate that with very specific traction points, that's awesome. Graduate from selective programs. I know some people like it. I'm a little bit less bullish on it, but it is what it is. And anything else, like being high-profile influencers these days is actually a big thing because it secures distribution for you. If you're a recognized subject matter expert, whatever that is, you just need to make sure that you look at your experience, close your eyes, and think about really tangible, impressive things you've done. And again, I think the best advice is treated like a dating game. So if you come to a speed dating, and you're among 40 people, unlikely that you would sit there and you would go, in 1991, I graduated this and I worked for Microsoft for 15 years. You'd kind of try to probably build it up a little bit to get the other person excited. So you need to do the same here. The way to do it, the picture on the right might be a bit of exaggerated, but it represents it pretty well. You can say, I work at McDonald's. Or you can say I handle transaction for a multi-billion-dollar company on a daily basis and help provide $2 billion to the US economy each year. Now, it's a bit of an exaggeration. Don't BS too much, but every person can find that angle around his or her experience, and it's going to be critical. So back to statistics, early stage VCs say the team contributes to 80% of their decisions. So just imagine that you're in this early stage, you're building your product, you're building all of those amazing features, you're thinking about technology, you're thinking about go-to-market, but at the end, 80% of decision in the pre-seed and often seed stage is the team. So obviously, the part that you need to work most on is the team, is thinking about who is your co-founder, who can you bring on board to strengthen that team story, how to present your traction in the best way. The second point, if you don't have a team, and again, a lot of companies don't have a team, then your best second thing to signal to VCs that you're a great company to invest money in is your traction. And we already kind of touched upon that a little bit, but what does traction mean? Broadly, I used to divide traction into three different things. One is founder market fit, so that's back to the team. And proof of your commitment. When I say proof of your commitment, it means if you're still working two jobs, usually it's kind of like, If you are trying to, met a lot of founders that are trying to run three ventures at the same time, again, kind of meh. The second is product market fit. So that's everything related to customer testimonials, usage, revenue growth. The other way to look at it is proof of work and proof of insight. So proof you have done the work, and proof you have a unique take or insight around how to win the market. And then the third one would be go-to-market fit. That's your burn multiple, LTV CAC payback, magic number, whatever that is. But are you able to take that product market fit and scale it in a very efficient way without wasting loads of marketing dollars, but actually have a very scalable and efficient go-to-market engine? In line with that, why VC says no. So if you look at Series A rejections, because this is not necessarily, I think it's going to be slightly, obviously, it's going to be very different in seed. In seed, it's going to be primarily because of the market is not large enough or the team is not good enough. In seed, it's again probably going to be, the team is not good enough, not enough traction, validation, maybe the market is not large enough or the market is not interesting enough. In Series A, probably like half of this, right, like more has to do with insufficient traction. So insufficient revenue growth, number one. Poor unit economics, that's your efficiency, number two. High burn rate, again, that's your efficiency, number three. Failure to meet milestones. So all of the top 3 to, four reasons are traction related. So just keep this in mind, because that's something you need to work on way ahead of some of the other points. And again, team here comes at 16%. So essentially, number 4 is still team. Team plus traction is your blueprint to success. And the one thing that's very true in 2025 and started being true in 2024 as well, you cannot wait for money to start building. A lot of people do that. I know I get this question. I don't have an answer for you, like, how can we build it if we don't have money? Well, you just have to figure out a way. Raising without traction is possible if you have an A-class team. So again, we worked on multiple raises, 4 or 5 million. People just presented wireframes. They have an excellent team. Investors look at it. They say, wow, here you go. Raise closed in 2 weeks. If you don't have the team and then you don't have a traction, then it's exceptionally difficult to raise money. The only way to do it is go to angels, go to people who understand your industry really well, raise a small round from family and friends, and build it to the point where you have that MVP, where you have the early customer validation or traction, and then you can take it from there. So the only 99% sure way to successfully raise is essentially focus on building, selling, and scaling, rather than fundraising. That can also be a very long and daunting process. An extra hot tip that's super relevant for environment today: if you lack direct intros, the best thing you can do is let your progress introduce you by sharing key wins and milestones on social. So that's your X, that's your LinkedIn. Again, I don't like it too much, but it's what 2025 looks like. 2025 generally, and everyone talks about it, will be a year of building in public. And what that means is, gone are the times where you require 10 NDAs for people to sign because you don't want to share things online. Like, actually sharing things online and building a public is your way to successfully attract VC investment. Why? It has a number of different things. Why? Number one is it shows that you have a well-spoken founder that's going to be able to explain the story really well. People are naturally gravitating towards founders like that. Number two, because you're building in public, you're building a community. That community very often becomes your first customers, very loyal customers, evangelists, etc. So essentially, you are already building your community-led strategy. You're already building your first adopter community, and that becomes an asset in fundraising. Number three, you're using this to publicly share some of the growth metrics and others without being or looking too needy and reaching out to investors, right? So it looks like you don't need money, and you're just building and achieving great success. And this is who VC love most, people who don't need their money. So this is why building in public, something definitely to consider as a way to magnet VC attention towards yourself. Now, from there onwards, how do we optimize your chances further? One, and I think you've heard this a lot, you have to create FOMO, the fear of missing out. But it's not how you think. I think 99% of people who are trying to create FOMO are doing it in a very wrong way. They go with investor in a call and they basically say, look, you need to get back to us in the next 2 weeks because we're also having conversations with really another big fund, and we already have this and this check, and this doesn't work. Swear God, investors call this BS really, really well. So the FOMO needs to be genuine. How do you create a genuine FOMO? The number one way to do that is run a very tight fundraise. Running a tight fundraise is opposite to what a lot of people are doing, because they get in touch with a few funds first, and then they get in touch with a few other funds, and then they get in touch with a few other funds, and then essentially you're running a dead fundraise where no one is jumping at you, and you're also losing momentum because the first companies or funds you spoke to, you can't come back to them and say, well, we've closed the round. And if they come back to you, you still haven't closed the round. It doesn't look good. So it also wastes a lot of your time. So back to the building stuff, instead of focusing on your traction and instead of building things, you're actually just fundraising, which means you're wasting your time that you could use building. So Best practice, 2-3 weeks planned intent exercise. Plan in advance who you want to speak to. Try to secure meetings fast. Obviously, you can't do that unless you've started networking way before. So ideally, still start networking way before. But if not, at least plan that outreach. Put your entire team to try to secure as many people as possible. Share them in a short period of time, and that makes it a much better chance of triggering FOMO. Something that also happens in that process is when you plan that tight fundraise window, ideally would be great if you plan some milestones around it, right? So let's say a PR article comes out just at that time so that investors would see it. A major revenue milestone is hit just at that time. You sign a really big customer. Like very often you're in enterprise space, you decide when to announce that customer. You announce that customer on LinkedIn exactly at that time. So people need to feel like momentum is happening again, because that helps to trigger FOMO. You need to invest in high quality stories. So forget the standard pitch decks. It's like problem and solution. I actually want to run another webinar exclusively dedicated to pitch decks because I see so many bad ones. So I think that's probably going to be helpful if there is interest within this community. But story matters, right? Like investors hear so many standard pitches. You can't allow them to get bored. It needs to be powerful. It needs to be founder-led. Ideally, you open by explaining why your experience is great and why you're invested in this problem, why you're passionate about it, how you're solving it. You very quickly get to, what's the near side market opportunity. You front load your story with good stuff like traction, and you make sure that it's really, really impactful. You need to secure warm intros, even if you don't know anyone. So the question is, how do you do that? The things that we've seen working most is, number one, you look at investors that you really like and want to work with, and then you look at their portfolio companies and you try to reach out and get in touch, not with investors, but with portfolio founders. Believe me or not, a lot of these people are absolutely great. They're happy to reply and jump on a call with you and listen, and then they can make you an intro. And that intro is actually very powerful. So even if you don't know anyone in the fund, you get that warm intro from one of the portfolio companies. Influential operators work as well. Investors, including those who said no. So we've seen one deal in the SaaS space in US. Investor said no, and then he proceeded to make intros to 50 other people. So he basically just sent a list and he said, this is the 50 people, but he would never send it unless we'd specifically ask for it, right? So you actually need to ask people, say no, and you ask them, appreciate your reply. Do you know anyone this can be a better fit for? And 1 in 10, 1 in 5 might actually introduce you to another 3 investors. Again, we have an exceptional case of a guy who just sent a list of 50 investors and said, cherry pick, who do you want? And I'll make your intros. People want to be helpful very often. So this is a very untapped channel. One founder we work with tapped into multiple different things, including, I think, like YouTube, podcast, and loads of other stuff. So essentially, I think leave no stone unturned. Don't think about it as a straight road. This is an investor and this is an intro I have to get. Think about who are other influential people in the space who can recognize the value of your solution. Maybe it's better to speak to them first and then they can introduce you to the right people. Now, if that doesn't work, or if you have exhausted that one, cold outreach does work. It has much lower conversion, but obviously zero downside. So the key is to personalize and be super concise. Statistics shows that cold emails and produce around 1.7% rate of reply. The really personalized ones are much higher. So I think you need to treat this more like a sales funnel. Identify investors who fit your stage, prioritize those that are going to be interested, hyper-personalized. Like a lot of people go down to writing, I've been following you for a while, I read your blog post, or I listened to your podcast, I heard this and this, and then write something very, very short and sweet. Again, outreach messages need to be super short. I see messages that are like 1,000 words and use a lot of weird words like, we are a transformational company that's driving innovation in the sector. Be very specific what you do. Like, we're a construction company that helps developers close deals. Like, I just came up with an absolutely ridiculous business idea that makes zero sense, but I think you understand. Again, like, we grew to X ARR in 6 months by solving problem X. Show always 1 or 2 impressive metrics, ask for a meeting, that's it. Don't lie and don't BS. It helps to secure meetings. It doesn't help you afterwards. So companies that say we have 100% month-on-month growth when you actually grew from 1K to 2K ARR, that's technically true, but it just, like, you're ruining the relationship with the VC community after. Like, you have to be genuine. You have to try to find those points, yes, but also be genuine around them, because people are going to be disappointed once they come on a meeting and they will not want to speak to you again once you ask them to add them to the quarterly update, etc. Do front load your deck with the strongest points, and never put traction at the back. It's what a lot of people do. They put traction at the back of the deck. Like, put it as much at front as possible. Like, all the best foot forward, because people have very little time to listen to your story, not get bored, and usually they make a decision in a split of a second. Remember that distribution is everything. So 2025, an interesting trend happens. I probably can talk about it for another half an hour to 1 hour, but essentially the new belief from the VC community is that product becomes commoditized because of an AI, right? You can find very small teams that are able to replicate probably what you're building very easily, unless it's a specific sector, unless you have like very specific IP. So distribution becomes the key, and especially in this AI space where you have hundreds of different companies basically building the same, it's your go-to-market strategy that decides whether people want to give you money or not. Have you figured out a really interesting way to take your product to market? It can be through community. It can be, for example, for a B2B product that you figured out a B2C way to get to the user. It can be like a bottom-up then adoption in the enterprise. Whatever that is, if it has a bit of a validation, if it has interesting go-to-market playbook, maybe some early distribution advantage, that's definitely something that you need to mention and spend a lot of time on, just thinking about what is your distribution advantage. So not just what's your product advantage, but distribution, go-to-market. Follow up sparingly. Don't chase people too much. Generally, you will know if people are interested, because if people are interested, they will follow up with you and they will drive the process. If you're following up, then they're probably not interested, but it's okay to follow up as long as it's not just, hey, John, any news? So ideally, always pepper in some positive development. So, hey, John, wanted to check in. We've actually just reached another milestone in MRR. We've actually just really, signed a very big customer. We've grown our pipeline by 100% to XYZ over the course of the past week. Never talk who else you're talking to. I think for big checks, that just not common. Start small to build social proof. Again, you don't always need, especially in super early stage, you don't need a lead investor to start taking on capital. So if you're pre-seed, better open a safe at a reasonable valuation and then start collecting checks from smaller angels. Obviously, it's very different in Series A. And remember that your round is not closed until it's closed. So until you have the funds wire, continue to focus on speaking with investors, and always set reasonable but quick dates for closes. Otherwise, we've seen some fundraisers taking 4 and 5 months just because the funds are not wired. So you need to make sure this fundraise is moving towards the dates that you've set. Finally, a quick laundry list of mistakes to avoid. So we still have a bit of time to address questions. Unrealistic valuation and round expectations. Please, there are so many benchmarks online. Don't come in and say, what is that founder I've just seen? Like a 10 million, or they want to raise like 5 million at 100 million valuation. Like, obviously that's not going to happen, especially if you don't have anything. It can happen in exceptional team situation or exceptional traction situation, but otherwise benchmark and like Carta.com is absolutely great, especially for US companies, to see what are the average valuation rounds, etc. SAM's larger than 100 million. And generally any text that says, if we just capture 1% of this market, that's a no-go. SAM smaller than 1 billion, and generally top-down market sizing is usually a big mistake. The biggest one, asking for an NDA before sending your deck, that just that can't happen anymore. I think we're like, no one is interested. So never do that. Never say we have no competition. That's a massive red flag. You probably heard that. Any situation where co-founders own less than 50% of the series raise, using your Gmail address. Like if you're starting a business, invest in having a domain. Gmail address alone will not disqualify you, but it is a bit of a red flag for a lot of investors. And when we come to that, if you're raising money, you need to be prepared to have like an investor friendly entity ready, right? So usually that's Delaware Corp or something of that sort. If you don't have anything, again, can be a bit of a red flag. You need to understand really well your business unit economics. So when people ask you about CAC LTV, even if you don't have it right now, you need to be able to come up with an answer and explain how your business is going to work. Your GTM strategy can't be a laundry list of channels. It can't be we do social, SEO, we do this and this. Obviously, you're going to do all of those things. That's normal. But what's your actual strategy to win the customers? Which channel do you feel is going to be most lucrative? And what have you figured out about the channel that's unique and not something the rest of the market is doing? No unfair advantage or no defendable moat. Obviously, again, massively important. And inability to handle rejection in the right way. So often people don't like the feedback. VCs come back and they say, look, we feel your market is too small, your product is not good enough. What's the wrong ways to handle it? One is, I've seen that. I don't like your feedback. Obviously, don't say I don't like your feedback. Don't start arguing. Like you can provide your perspective, but thank for the feedback nonetheless. Ask if anyone else can be interested. Ask if you can stay in touch. Use that rejection as an opportunity to grow. Ask specific questions. I think very often people come back and just say, we really like everything, but unfortunately it's not for us. Just say, can you, I was really excited about this. I felt like I really like your fund, guys, and what you're doing. So I'd love to understand, is there an opportunity to work together in the next round, and then what kind of metrics you would be looking at, et cetera. So again, gain the information, turn this into a knowledge opportunity rather than just being sour about it. But mistake number one is basically remains the same. It's stopping the progress or waiting, sitting and waiting versus actually building. I know it's not the magic bullet a lot of people are expecting, probably. It is what it is. It is the truth for 2025. Great companies are bought, not sold. So if you don't need the money, people love to give it to you. Focus on building a company so compelling that investors are going to end up chasing you. And that's a wrap, almost. So what's next? How can I help? I'd love to connect with you on LinkedIn. Add me on LinkedIn. Always happy to chat. Send me questions there as well. If I'm able to, I promise to answer. We have launched a fundraising copilot that's in a very, very beta mode. So we haven't publicly launched it yet. It has library of slides from like 10 years of successful fundraisers. It has curated list of over 1,000 VC contacts. It has loads of downloadable pitch decks that actually raised money and then were just sanitized and turned into a template. The same with financial model. It's 60% off just for the next 24 hours if you use the promo code here. So you can screenshot this and check it out for yourself. It also has a very exciting VC quiz that a lot of our VC partners really like because they find that it very correctly represents if the company is ready to raise or not. So you can pass the quiz, you can see your marks, and then you can see which areas you need to focus on to be a little bit more attractive for the investors. And then finally, we do also assistant fundraising help. So we actually do help Taylor to do pitch decks and modeling, and then scaling after to product market fit and market research and much more. So you have my email here. Mention you come from webinar. I get a lot of emails I don't reply to. So, but yeah, this is what we can do. And thank you. May the force be with you in 2025. I know that we are a little bit over time, so I'm going to look into questions and try to answer some. I understand some people might need to leave, so guys, whoever needs to jump, please jump. And otherwise, I'll still try to go through the questions and answer some of the ones that we have here. Okay, there's a lot of questions. Okay. I found where it's okay. Where you mentioned red ocean, what are the biggest red ocean tech cybersecurity? What do you think is blue ocean in 2025? It's a difficult question. Like, I think with AI, everything, like a lot of things become just red ocean. I think it's about finding your specific niche or take or an unaddressed audience within that is blue ocean. So like right now, we were talking about construction tech, for example, and there's loads of companies there. But for example, within construction tech, you have the pre-construction process that not a lot of companies are addressing. So you have this like specific sub-segment market need that still looks pretty blue. And I think that's probably the approach that I'd recommend to take. Biotech is on a hot list, but horizons for revenue are very far off. Do you have insights on this? Yes, that's why biotech and deep tech are always in the exceptional category, because companies we work with, they get to Series F and actually still don't have any validation or any revenue. So I think with the biotech and deep tech, you need to build the specific milestones that make sense to investors, but they're not necessarily revenue milestones, and then it's okay. You still need milestones. So you basically raise money to get to the next approval, to get to the next testing phase, to get to something that increases your valuation because you're progressing on that validation continuum. Okay, how to best access new angel syndicates? It's just research. Like, in all honesty, all of this investor outreach stuff is just a lot of research. There is plenty of tools. You sit down, you ask ChatGPT, you press the deep research button, and you do, again, leave no stone unturned. You go on LinkedIn, you look for angels, you look like which parts are they off, and you speak to people. You find out where they're raising. It's not a shortcut, but it's the only thing I can recommend. What's the view on angels and first checks in Middle East? And then generally my view is the market there is still very underdeveloped. I think there are a lot of great angels in Middle East. You just need to make sure that what they're asking for is not unreasonable, because a lot of the deals that we've seen, they ask for 50%, and that's obviously way off the mark, and they don't bring a lot of value with that as well. So you need to make really ironclad sure that they are bringing value, that's A, but also that you don't give away more than 20%, or like, let's say 25% or whatever the benchmark is, because you are not going to be able to raise a follow-up round. And yeah, just do due diligence really well, because choosing an investor is, I mean, that's a total cliche, like choosing a wife. I think sometimes it's worse, because it's easier to divorce a wife than it is to break with a specific investor. And you need to do your due diligence. It's, I think, one of the mistakes that should be there, but it's not. People are so eager to take money that they don't ask investors, and they don't tend to understand whether their values are aligned, whether their vision is aligned. And in Middle East, that very often backfires when investors want to push the company towards profitability rather towards growth, whether they are very quick to sell, whether there are a lot of disputes. So yeah, just make sure that's not the case. If a company has raised a safe round from friends and family of $500,000, do you think it's possible for them to raise another $1 million as pre-seed? Yes. I mean, I don't see why not. Happens quite often. You covered VC activity in Europe, EMEA, and LATAM. What about APAC? How's VC activity there, and how we in North America could benefit? I think APAC is a very close-knit market, so it's very difficult for APAC companies to raise money outside of APAC. It's possible. There are some investors who are specifically from US are looking towards APAC, and the reason they're looking towards APAC is because valuations are much lower. So you're able to, interestingly, cover, potentially grab a very nice startup at a very low price and much lower competition. But for startups in APAC, situation is generally difficult because there are very few funds. There is a very nascent ecosystem, and they need to raise the first round locally. So I think in terms of valuations and round sizes, they fall on the chart towards the the rest of the world. In terms of activity, VC activity, not major. Again, it's a very close-knit community, so you need to network a lot early on. And I think very often the first check comes from strategic investors or angels or people in the industry who understand really well what you're building. Okay. Ahmed said, how much do you charge for your services? What's the promise? And investments or just readiness to be investable? We never, ever, I would say, guarantee that someone is going to invest in you. That's just not our business. I'm sure you can find loads of people who do, but we just took you through a presentation where we said in early stage, 80% of success is team, 20% is traction, or maybe 80% is traction, 20 is team, depending on what team you have. We can help to coach the team, but we can't change the team. We can't, put an exit. We equally can't get traction or validation. Like we can help with meetings, we can help with the story, we can help with what are the red flags. Like what we do really well is we sit down and we do assessment with you around, are you ready to raise money? What are your strengths? What are your weaknesses? How to position it best for investors? What do we need to work on? And then present materials that are defendable, like the pitch deck that resonates, that converts a lot. The financial model that makes total sense is ironclad. The metrics are there. Everything is there. So you have your blueprint to fundraise and even grow after. We can help to say, your go-to-market is not good enough. This is what we recommend. The business model doesn't work, etc. But we can't say that, we're going to raise you money. And everyone who can, I think, is probably lying. But that's just my take on it. Okay, metal recycling via zero emission, end-of-life vehicles, do these come good in climate tech? Generally, yes, but really, again, comes down to, is it defendable? Is it different to what others are doing in the market? And then does it have great traction, early validation, etc.? So as a kind of sectoral thing, yes, but whether people are going to invest in it, I need to dive deeper to understand. Okay, a question from Abhas who says, we have traction, we have an experienced team that never raised funds. We never raised. We used our own savings to get to a milestone of profitability, 4 to 5 million annual revenue. Where do we stand? We don't have 2 of the 3 required points. I think you probably stand pretty well. I mean, if it's a team that bootstrapped and got to 4.5 million annual revenue and is profitable, then you're already at a Series A level, almost. That means team is less important at that stage because you've proven that you can execute because you got to this revenue and profitability. So you're probably in a good position, but reach out. I'm happy to chat with you because I need to know more. Like, is the growth still there, or at least some level of growth? If it's an interesting industry, a lot of companies are at the same space, but they're in a service business. No one from the VCs wants to invest in service space. So kind of depends a lot. Okay, how do VCs look into startups run by more old school 50-plus-year-old founders, but have a very promising project on their hands? And is it a very big problem for team-oriented investors, or if VC like the project, they don't mind that? An interesting one. Look, I think ageism is always going to be there. It's the same problem for still, I'd say, women, diverse founders, very young founders, like anyone who doesn't look like your standard VC would have some questions. But have we seen, 50-plus-year-old founders successfully raising money? Absolutely. If you're passionate, if you're super energetic about a project, if you've positioned your traction and expertise really well, it's going to work. With a caveat, I think it works better with investors who look similar to yourself, right? So obviously, if you are in talks with a very young VC analyst, can be a bit worse. But overall, if the project is promising, if there is, if you're a founder of Cursor and you got to, 100 million, you're on track. Okay, any other, like we work with loads of AI companies, and you produced 1 million ARR in 6 months, people are not going to look at your age. Now, if you haven't done anything, if you kind of have a promising idea, then yes, it's going to be challenging. So it comes back down to, do you have something to validate your execution capability? Okay, how and where can I start engaging with investors? And do you have recommended platforms? I haven't myself tried a lot, like old school. I think it's still platform-wise, it's LinkedIn. The best things come in person. I'd really say look into your local investors. It's a little bit more difficult if you come from, let's say, San Francisco or London, because the networks are so large. But we've had tremendous success, for example, with someone from San Diego, because San Diego is a much smaller space. They've met a lot of investors there who genuinely really wanted to help to someone from San Diego. So they were doing a lot of intros and a lot of hands-on help. So I think identify some local community and networks. Meeting face-to-face is number one, best still, despite the COVID times. And then LinkedIn. Otherwise, I would try other platforms that have a lot of, like, I'm not sure if OpenVC, like other stuff. Again, we have a platform through which you can find investors, etc. But engagement, I'd say email and LinkedIn are still unbeatable. How, and I guess that covers kind of the question, yeah, how and where. So just start engaging, identify a list, start talking to them. Again, face-to-face number one, and then otherwise email, and then otherwise like LinkedIn. Okay, SOMs larger than 1 billion for a pre-seed company, that's fine. I think, again, depends how much larger. So if you have a SOM that's 100 billion, that's not good. If it's a SOM that's 2 billion, that's okay. Question from Alan around, what's the overall experience with the Middle East VCs? At what point or situation should a European-based startup seek funds there? I think I've kind of replied this partially, but I think they often have, so there's a very few kind of true VC funds in the Middle East that are very good. I think those funds, they're great. Whenever people engage with them, we only hear the best. However, there are very few of them. So if you engage with someone outside of that, you just need to be a little bit careful around the valuation expectations, what value they bring in, etc. I think again, it's always easier to raise locally, but if you feel there is an opportunity in Middle East, go and talk to these people. Like right now, a lot of Middle Eastern investors are looking to invest in states, in European Union. So if you feel there is a synergy, if you feel like this is a good investor, why not? One big development in the Middle East, or I think one big funding market that doesn't exist in Europe is actually, corporate VC funds. So they're big companies have their own like investment arms, and they're non-traditional VCs, but they actually tend to invest, and they also tend to add a lot of value because they become your exit option potentially down the line. They help you with distribution. So that's something that's just interesting to look into. Question from Andrew. No unfair advantage, no defensible modes. In every software business, everything is replicable. Beyond having a large data set, which itself is also replicable. What are good answers to that? Distribution, as I said, it's your ability to kind of distribute. I think 50%, maybe more, of investors are going to agree with you that every software business is replicable, unless you're, I don't know, building some super unique hardware space rockets or something of that sort is going to be replicable. Data is a little bit better because data sets can be unique. Like we've seen that some companies do have access to unique data they've been collecting for a very long time that's not public. So they have that kind of historical advantage. So data can be unique, but yes, in most cases, and in the future, most probably, it's going to be less unique because there's going to be synthetic data. There's going to be, again, commoditization of data business overall. So in the space where there is no unfair advantage, there is no undefensible mode, what becomes your moat is your distribution and you go to market. I think it's one of the VCs who said that first-time founders are obsessed with product and second-time founders are obsessed with the distribution. So it's your go-to-market playbook, and have you figured something really interesting there? Okay, David, question. What if my SAM really is over 100 billion? How did I mention it in my deck? You change your SAM. You know, your SAM is your definition of SAM. You know, you can narrow down the geography. You can make sure that the numbers are cross-checked and you're really sure in them. You can narrow down your ICP persona. It's not about the fact that it's bad. It's usually just an indicator that you're taking a market that's a little bit too wide, or you haven't checked your assumptions. So if you checked your assumptions and it's still 100 billion, then it probably means that your ICP is too wide for your current stage of journey. So that's a feasible market for like a Series B plus, but for seed or pre-seed Series A, probably just means you have too wide of an ICP and you need to narrow down on it a little bit. Question from Kumar: how to structure a global raise for a global fintech regulated in each country and will have specific needs for each country? You don't do a global raise because people are not interested in having a global raise usually for a fintech that is regulated in each country. And if you look at every super successful fintech, there is always like a very specific strategy around taking specific markets. So you usually start with validation in one market, you pick the biggest one, might be, you get the traction there, and then you gain traction in another market or another region. And then once you're much bigger, you can raise from one of the big VCs to go global and execute on a multi-market strategy. But doing that from the very start is probably going to scare VCs off. How angels or VC investors feel about LinkedIn reach outs? I think they feel good. Like there is just no one will ever tell you, Alan, I hate that you're writing to me. I think people just need to feel respected. So if you send a very generic message, that's clearly a very generic message, they're either not going to reply or they're going to be pissed. But if you send a message that's human and very specific, right, and kind of goes, hey, I've been looking into what you're saying, and you've been posting this and this, or like I'm really interested in one of your portfolio. Like, make it human. Don't make it sound like AI. Don't make it sound automatic. And then people very often reply. So we get, we help a lot of companies we work with on outreach, and a lot of people reply. It's not in our thesis. We're not investing right now. We don't have money, but people reply, I think, feel good. Some of these people convert into meetings. Some of them convert into term sheets. So you'll never know until you try and find a way that works for you. Okay. Question from Echo: if we're going to get a copy of this recording? Yes, you will. I can't guarantee that you're going to get the slides. We haven't decided yet, but we will provide a copy of the recording. Question from Kumar: do you do investor interest or have access to a pool of investors? Yes, because we work with them for quite a lot. I have to say, a lot of investors we work with, so we don't actually have great connections with angel syndicates or anyone who's pre-seed. We do have good relationship with funds that are looking at traction, so 1 million plus. So if that's the case, feel free to reach out and we can see if there's synergy there. Okay, final question. Can't believe I got to the end of questions. This is great. Okay, I'd love to understand a little bit more on your opinion on CVCs. Are they usually an exit opportunity or customer? Are they more patient with longer investment cycles? What has been your experience? Again, I've only seen CVCs in the Middle East, so that's been our experience. In the deals that we've seen, can be both. They can be an exit opportunity. They can be a customer. Very often, they're both. So they're a customer and an exit opportunity, or they're a great distribution mechanism and an exit opportunity. I think they're more patient with longer investment cycles. They're also prioritize profitability over growth very often. So if you don't have a great growth track record, if you're not growing 3x year on year, then it's helpful to contact them, because if you're profitable, but you have kind of like a slow business, I think that's a great fit. The one thing to just be aware of is I think that they move much slower compared to traditional VC. So if you're in a time crunch and if you're at the end of your runway, then it might not be the best option. You have to start engaging with them way, way early on. I think the last company that we've seen that got invested in by CVC, and that's like a major company in Saudi Arabia, but their due diligence alone took like 5 months for them. And that's like a company that was only started 6 months ago. There was nothing to really do due diligence on, but it's because they're kind of just big and it takes them longer time to respond. Okay, end of questions. Sounds great. Thank you very much, guys. It's been a pleasure, and I do plan to organize a couple more of these. So if you have ideas, if you have any specific questions, send me them on LinkedIn. We might be, just doing something around that. And have a couple of, we can definitely put together a webinar specifically around investor outreach, because we have a lot of expertise there around deck building, financial modeling, loads of other stuff. So whatever topics are relevant, reach out. And most of all, best of luck. I know that this is tough, and I know every day is a freaking struggle. So you're all heroes. You're doing great. Whether or not this specific thing works out, you're gaining invaluable experience. So you're doing the right thing. Good luck. Have a good night, good rest of the day, and I'll see you some other time, maybe in some other webinar. Thank you.